Welcome to the 2014 Milken Global Conference Real Estate Panel. Today, this is not only a smokeless-free environment, but given that we have 5 incredible panelists, it's going to be a little bit more of a shtickless-free environment for me. Normally, I come in and say a bunch of terrible jokes, and people get offended, and then they come up to me and say, well, I really liked it. It means I just shame people. So in their private life, they like me. In their public life, they must reject me, and I accept that. But I hope today you'll accept incredible wisdom from 5 gentlemen here. And all I can say is, ladies and diverse people, Donald Sterling did not pick 5 and, well, 6 white men up here for you.
Oh, yeah.
Too soon.
He was just channeling his inner Don Rickles. That's his defense. Anyway, let me introduce today's panelists. I'm going to do this in alphabetical order. We all know that we have great people here, so there's nothing implied with respect to how they rank on the pyramid of success. The first is Bill Kahana. Bill is the CEO of RCS Capital and a co-founder of AR Capital and CEO and director at American Realty Capital Trust. He also serves as a director of ARCP. And Bill's been active in the structuring and financial management of commercial real estate transactions for nearly 40 years. And he's had a number of great posts, including with Catellus and American Financial Realty Trust. He went to college locally here at Occidental, which is where my brother went as well. My brother did not do nearly as well as Bill Kahana, but he also has a JD from UCLA and an MBA from Stanford. Thanks for being with us. This is the first time you've been here, and you do smell like a new panelist. I just want you to know that. Yeah.
Whatever that means.
Whatever that means, exactly. Bill McMorrow has been here many times. He's a good friend. He's the chairman and CEO of Kennedy Wilson, which he purchased in 1988 and has built it into a company with 24 offices in the U.S., 2,000 operating employees, and last year I think he had $13 billion under management. This year he has $17.5 billion under management. Is on an incredible tear. He's in Spain, Japan, Europe, and the United States. And we'll talk further about his European IPO that was just successful. Jonathan Pollack is the managing director and global head of commercial real estate and also the head of risk for structured finance at Deutsche Bank. And his business finished #1 in all of debt, high-yielding lending, especially real estate debt last year. So he is, right now, he's ranked as one of the top influential people in real estate given the comeback of the CMBS market, which makes, as we discussed, his mother very proud and his wife even prouder. Jonathan, thanks for being with us. You also are new and also wearing a purple tie. It's actually all the people with purple ties are new, including Henry Silverman, who's joining us as well, the global head of real estate and infrastructure for Guggenheim Partners. And Henry, before joining Guggenheim in 2012, he was the CEO and vice chairman of the board and member of the executive committee of Apollo Global Management. And he also was the CEO of Cendant at one time before that, and which was the largest global provider of consumer and business services and travel and residential real estate at one time. Thanks for joining us, Henry. We look forward to your remarks. And then we come to the person who truly is the most interesting man in the world, Sam Zell. Races motorcycles, flies planes, spends more time than anybody else in the air, in an airplane. I don't know, 1,800 hours a year. It's a lot.
A lot.
And knows the world extremely well. I'm amazed that we were able to get Sam with his busy schedule to be with all of us here today, and I thank you very much, Sam. So let's begin. Let's take a tour around the world a little bit. Quickly, slide 1, please. If we can get that up there. GDP projections for major economies show growth in most areas, Australia, emerging markets, Euro, coming out of recession from last year, Japan, where Bill has investments, the UK, and then the United States. And then let's look at top cities by real estate volume where demand is. One more slide, slide 4, please. Sam told us some years ago when everybody was bailing on Manhattan that New York would be the #1 market. I think he was right. London behind that, Tokyo, LA is back, almost $30 billion. DC, San Francisco, you can see how it all plays out. Look at how much is America, though. Look at what we have in America. So with that in mind, I'm going to start my question for all of the panelists. I'm going to begin in reverse order. Sam, I'm going to go with you. What assets are you buying and where? And where are you selling and why?
I think that from a worldwide basis, we've done a lot in the emerging markets. Our probably #1 emerging market investment arena is Colombia. Colombia is doing very well. It's dramatically benefiting from the free trade agreement with the United States. Multinationals are coming to Colombia for the first time to use that as an avenue to reach the United States. So as far as Latin America is concerned, we would probably rate Colombia #1. We're also significantly impacted by the change in the capital markets in Latin America. 2 years ago, a proposal was launched to merge the stock markets of Chile, Peru, and Colombia. That should be completed by the end of this year. What that means is that the new bourse will be the second largest in Latin America after the Bovespa in Brazil. So it should act as a funnel for capital into those countries, and particularly Colombia and Peru that have significant growth opportunities. I think it's going to create some really terrific opportunities, and we're very enthusiastic. I think that in other parts of Latin America, particularly Brazil, as everybody knows, Brazil's growth rate has shrunk receded from roughly 8 or 9% to 1.5 or maybe less. But what's not really focused on is that the amount of capital available in Brazil has shrunk a great deal more than, in effect, the GDP. So whereas 2 or 3 years ago, Brazil was growing at 8% and competition was vicious and it was very hard to make a deal, we find today in Brazil, there's no competition. There's no capital available. That makes it a much more attractive market. And kind of, you want to contrast that, you contrast that with China. There's no shortage of capital in China, despite what the newspaper headlines say. And the result is that we think China, for a foreign investor who isn't in a strategic business, and like just real estate, unless it's a very, very specialized kind of product, makes no sense for us. We tend not to invest in Europe simply because you make investments predicated on demand. We don't see any demand in Europe, and therefore find it, from our perspective, unattractive. As far as the United States is concerned, the United States is suffering from just a massive bout of uncertainty. I think the political environment has dramatically impaired the investment environment, with the result being that I think that the stock market and, frankly, the real estate prices are significantly ahead of the progress of the country.
So are you a seller of domestic assets?
I think there's a big difference. I mean, even though I probably get quoted often as saying, the day you don't sell, you buy, There is a gap in between. And I think when you think about the United States, I think the first thing you have to think about is the fact that for practically the last 8 years, we have built nothing. There's been no period, certainly in the 50 years of my career, where we have had such a dearth of new supply. And so, to some extent, if the economy, quote, had recovered, we probably would have had a lot of new supply. The economy didn't recover, therefore we don't have a lot of new supply. Therefore, I think you got to focus on the transaction rather than the market, because it's the transaction that creates the opportunity.
Great, thank you. Now, obviously, you were not favoring Europe. Bill's taken a big bet in Europe. He went to Ireland. He went to Spain. He acquired a number of assets and recently did an IPO. And Bill, same question to you. Where are you seeing value? Where Sam talks about his money being more valuable in places like Colombia because of his ability to make it pay off more, as opposed to going to China, where he's got to deal with a very uncertain place. How do you find Europe? Is your money worth more there?
Well, I try and keep my perfect track record with Sam here. So we're very focused on Europe. And if you look at what we've been able to do there, we went there in 2010. And our focus has really been Ireland and the United Kingdom, and now we've recently bought a large property management and servicing company in Spain. And so in the markets that we're in, there are fewer opportunities here in the United States, although we continue to grow our apartment business. But this year, probably 80% of our capital is going to be invested in Europe. And as you mentioned, we just, with the help of Jonathan's company, Deutsche Bank, we just finished the second largest IPO of a real estate company that's been done in the history of the London Exchange. And so, you know, we've raised a significant amount of money here in February, and so we're busy really deploying that. There's still plenty of opportunities. There's fewer opportunities in Ireland. It's a smaller market, and it's gotten you know, more crowded. But there are still plenty of opportunities in the United Kingdom and Spain.
Gentlemen, what's the impact on international real estate as a result of what's going on in the Ukraine? Sam, Bill, you're both touched by Europe. I heard last night from the IMF that every time the Russian economy goes down, the GDP goes down by 1%, all the neighboring trading countries go down by 0.7%. So they're all hit pretty heavily. And much of Europe, of course, trades with Russia. Does that have any, is that short-term phenomenon a real concern to you at this point, and how are you dealing with that?
It really doesn't have much of an impact, Lou, on our business. I mean, I think, not to belittle it, but these things, you know, there's always some crisis going on somewhere. I think the big thing that has happened in Europe that, you know, Jonathan can attest to is that the debt markets have recovered so quickly in Europe over the last year. And so what's really driving the recovery in Europe are the U.S. financial institutions that are now actively lending in the markets that we're buying in. Spreads are decreasing. There's more availability. And so that's really what we focus on really more than anything is the availability of capital, not really what's going on in the Ukraine.
And I would add to that the availability of investments, right? I mean, I just ran into half your team in Madrid on Thursday night looking at a big portfolio that we're also looking at. I mean, one of the reasons Spain is a big focus area for a lot of the U.S. private equity funds and financial institutions is that the government is going through a sort of forced liquidation of legacy assets in their banking sector. And so that just creates interesting investment opportunities. The other thing they're doing is they've instituted some really interesting reforms that should set Spain up to be, you know, an outperformer in terms of growth in the Euro region over the next few years. And I think those two things combined make it a really interesting place to be spending time. You know, I agree with what Bill said. I think it's just the things that are moving that picture are so much bigger than, you know, some micro measurement of an impact of a crisis in some, you know, some country in a neighboring region. It's just we're still dealing with very big macro picture things in the varying speed recoveries in these countries in Europe right now.
I wonder if we were sitting here in 1938 and Neville Chamberlain came back from Berlin and said, "We have peace in our time. I'm sure the real estate in London won't be affected by what Hitler did in Czechoslovakia."
Right. But would you have sold everything you owned in London at that point?
That's not the question. The question, the real question is, is Ukraine, another Haiti problem, or is this a major, serious worldwide crisis?
Yeah.
I just think that this is extraordinarily dangerous. I think the assumption that Putin is rational has been, thrown down the tubes. And I think we're all going to be affected, and I think Europe is going to be the most affected. I mean, look at just the issue of sanctions. In other words, you're investing in Europe. Whatever sanctions the America puts on Russia are going to have minuscule impact on America compared to what the impact will be on Europe. So I find it incredulous to hear you guys saying, "Well, it's just an event. It's just another one somewhere else. Big deal."
Okay. All right. Okay, let's move to the capital markets. Let's look at slide 8, if we could. It is, last night, we did have, I was privileged to be at a dinner where Tony Blair spoke, and he did agree with you, Sam, that the only thing that Vladimir Putin really understands is a strong defense, because he's a very aggressive person and it's a different world. So something I'm certainly going to be looking out for. I didn't mean to trivialize that, but I couldn't resist just moving on. Okay, so slide 8, the reemergence of the capital markets. Jonathan Pollock, your wife, is going to be proud of you again, because we're going to talk to you a little bit about this. And then we're going to also talk to Bill Kahana about the capital markets. DB was the most active book runner for CMBS transactions in 2013. And we had an absence of credit for a long, long time. What's the future? Is it coming back? Is CMBS, should people start ramping up their teams on the CMBS side?
Yeah, look, I mean, the CMBS teams have been re-ramped. I think the availability of capital in real estate in the last 12 months has gone through the roof relative to where it was even 2 years ago. Even if you look at the different conferences you go to as a bellwether, this year in January it felt like we'd moved a whole quartile in about 6 months in terms of the availability of capital and the way pricing was happening in the real estate debt and equity markets. So there's plentiful debt available for everything from your 10-year fixed rate loan at 4% to your transitional property. There's public companies that are sponsored by private equity firms. There's private equity funds that are raised now that are happy earning 10 to 12% levered returns, and so those phenomenon drive yields way down for credit. And I think the ability to do sort of a financially engineered real estate investment now is far greater than it was even a couple of years ago. I still don't think we're seeing leverage come into the system the way it was back in 2007 when we issued entirely too much CMBS. I think we'll see this trend continue of moderate amounts of leverage using low interest rates as sort of the driver for returns. And also I think that coupled with that, this low interest rate environment, not only is it helping drive returns, but it's also creating lower return expectations, which is driving up real estate values. So that I think that's the picture in the States. In Europe, the markets, the financing markets haven't recovered nearly as much, although I think that's at this point a function as much of lower transaction volumes than anything. I think there's an interest in buying CMBS among European investors. There's certainly large interest in providing real estate debt by banks and insurance companies. There's just not as much transaction volume in Europe. Whether that's because banks in certain countries aren't liquidating real estate, or whether that's just because the owner-occupier rate in Europe is basically 65%, which just makes the investable supply much smaller. So the recovery of debt markets has been slower there, but I think pricing and availability of capital is plentiful there as well.
What's going to, there are a couple of factors that concern me and maybe other members of the audience. The unwinding of stimulus and the effect that that's going to have on interest rates, as well, and where Janet Yellen is coming from, what's available after that, and what impact is that going to have on all the debt? Is it going to be the same kind of extend and pretend and move it forward, or is there going to be a reckoning? And I know Sam has strong feelings about people who use terms like financial engineering, because the spreadsheet has been one of the reasons that the world has crashed as well as excelled.
Look, I think we were talking about this in the prep room. I think it's there's a lot of different views in this room and at this conference about where rates are going to go from here. So far, largely the market, the prevailing view has been wrong, right? If you asked people a year ago where they thought the 10-year was going to be at the end of 2013, they would have said about 3.5%. Came in at about 2.5%. It's about 2.70 today. So, you know, I think everybody is prepared for the notion that rates should go up from here, but it hasn't happened. What the impact will be, I'll leave on real estate prices. I'll leave to the real estate investors on this panel. I just think it's an incredibly hard thing to predict. The things that are impacting the long end of the curve are, you know, so wide-ranging. It's everything from labor rate participations in the U.S. to, you know, technicals about who owns government debt to, you know, just very, very unpredictable picture. And I think, again, I don't think anybody would have predicted we'd be sitting here with rates roughly the same as they were 12 months ago.
Bill, with potential interest rates rising, let's take a look at slide 22, please, if I could. With interest rates rising in the future, and I know you can't predict, but how important is access to the public markets for you and your business, as opposed to you know, a way to find yield in the net lease space, getting cheaper access to capital? What happens when that's not there? And
well, I think it's important, Lou, that everyone begins on the same foot by understanding our business model. Today, through 13 programs, and 13 for me is not an unlucky number, we manage $40 billion of assets. And those programs include healthcare, they include various food types of retail, single-tenant net lease, grocery-anchored shopping, power and lifestyle centers. They include, because I took a page from Sam's book in 2010, a focus exclusively on New York City. They include some financing programs that touch on real estate, as well as corporate private borrowing. In every case, the unifying factor is that we raise equity capital through our New York Stock Exchange traded full-service securities firm called RCS Capital, RCAP. And that capital then goes to feed on a blind pool basis sector-specific strategies, each independently managed and governed. And that money is raised, deployed, managed, and in turn harvested by going from the non-traded, non-listed space into a strategic sale and or a listing.
Can I get slide 23, please?
Here's what I know. I know if you put 4 economists in a room, you get 5 different opinions on interest rates. But what I do know is over the last 50 years, on average, the 10-year has traded a little over 6.5%. And today, you can borrow 400 through. I know that much of what we do basically match funds. So in our first 5 net lease programs, we raised and deployed $7 billion of equity and returned $9 billion. I know that we're less sensitive than most real estate programs to interest rates because my stabilized borrowing is about 20% loan to cost. And so by match funding, putting that money to work and then harvesting and returning that value, either by listing that company and or selling that company for either a security which trades, as we did with our first net lease REIT to Realty Income, by building it at $9.80 and selling it down at $13.35. The fact of the matter is that it is absolutely essential that we have access to capital, but most of our success in our foundation was built when capital was in large part not available. So we did it by raising cash and putting it to work at cap rates that were exponentially better in 08 and 09 and 2010, with most of both the debt and equity capital sidelined, and buying strong credit at 8% at 12.5 times, and watching some of that cap rate compression and keeping our leverage low and keeping our head down and focusing on what we do best. The thing that frightens me in Sam's comment is only that he's right, and that I watched the so-called Cyprus banking crisis, which was hardly that, drive our values down in our traded securities by 10, 12% in a day. And most of our investors don't know where Cyprus is. So the listed market trades on fear and greed in large part. The non-traded space gives us the opportunity, the quiet time, out of the noise and volatility of the public market, to build and then harvest these strategies. And I can tell you from the standpoint of the 15 million American families and the million investors who invest with us, who are looking at outsized returns, that as long as interest rates stay low and they don't have better options, certainly not in their bond portfolios any longer, they will buy hard assets, professionally managed, and they will find their way to real estate.
Sam, did you want to add anything? Okay. Let me follow up. People in the audience may or may not be familiar with the non-traded REIT space as much. The non-traded REIT space allows an investor to put in a much smaller increment of cash. They go through broker-dealers. It can be anywhere from $25,000 to $50,000 as opposed to buying a complete asset. Crowdfunding is a new topic that it basically raising securities on the internet, or money on the internet through the sale of securities. And all of this came really to a big head, and it's moving through Congress and building up a lot of steam as a result of the Obama Jobs Act. Is that a threat to this notion that you're able to get these smaller increments, therefore there's therefore there's a million investors and 15 million families, as you say? Crowdfunding, somebody puts up a product, puts something up on a site, and then people can come in and buy and select it. Is that a threat to this smaller increment practice?
No, it's not only not a threat, it's a complement to what we do. My costs through the independent broker-dealer channel to raise equity are about 10%. Crowdfunding, it's about 5%. Now, I know very little about crowdfunding other than we're investigating it. But the fact of the matter remains that 3 years ago, if I were to sit here and talk to you about crowdfunding of any sort, real estate or otherwise, it would have been around 0. And today, crowdfunding, at least the last 12 months, raised $6 billion. $6 billion. We see it as another potential avenue to raise capital.
Okay, very good. Henry, you've been so quiet there and so patient. What role is leverage playing for Guggenheim today, and where are you investing, and really what's the outlook from your perspective?
Well, Lou, if you could put up the last slide in the deck, I'd like to give
the last slide of the deck?
Yeah,
okay.
I'd like to give some context. So we look at the risk spectrum as all the way on one side is a senior secured mortgage, all the way on the other side is ground up development. Those are probably the goalposts. And we're focused on both sides of that. We're trying not to play in the middle because, as some of the other people on the panel have said, we don't know where interest rates are going. Scott Meinert, who is the Guggenheim CIO, predicts that when rates go up, and I don't think Scott knows either, but when they go up, they're going to go very quickly, which means that not only are you taking the normal real estate risk and the normal real estate operating risk, but you're taking cap rate risk somewhere in that middle, because historically, when interest rates rise, cap rates go up as well. So we're trying to either do one or the other. We're doing a lot of senior debt, a lot of floating rate senior debt, which gives us some protection. The borrower typically will do a swap to fix his or her rate. And we're doing a lot of ground up development, including, as an example, the building that we're sitting in, as many of you know, with the current owners, we've invested in this property. We're building a Waldorf around the corner, and we're building condos on the front end of the property. So we're at different ends of the risk spectrum, and we're trying to really avoid the middle because we're not sure you're paid for the risk that you take in that middle. I'd also add to your question about crowdfunding that we are interested in that space in real estate. I think it's going to help sponsors because it's going to provide a source of retail capital at lower cap rates than any of us can raise or borrow at the moment, which can only help returns.
I think that crowdfunding just basically asks the question, are real estate securities bought or sold? Because if they're bought, crowdfunding makes a lot of sense. But if they're sold, crowdfunding will never accomplish it. And I think that, at least at the moment, and I don't think you disagree with me, your money is raised because you have people selling your product.
80% of our equity is sold, not bought, as Sam likes to say, and he's not wrong. But 20% from 0% is bought, not sold through the RIA channel. And that model, as you know, is agnostic to a commission it charges back to the client, or is based on performance or assets under management. So you're right, but I would tell you directionally, I would suggest that wind has changed. It's my view.
That would be terrific if it did.
Well, let me put it this way. We raised $9 billion last year. Just under $2 billion was raised for the RIA channel.
Let me just do a test of the audience, because I want to find this out. If any of these gentlemen, given their credentials, put a project up on the internet and allowed you to go in and see that project and underwrite it and make sure you're comfortable with it and had a return that made sense, would you press that button and buy a share of just off the internet? How many people would feel comfortable doing that? That's a hell of a lot more than would be expected in a lot of places. So I do see that as a trend that needs to be evaluated. One bad deal, though, somebody's going to do a bad deal, and that bad deal is going to throw a wrinkle into crowdfunding. And so securities laws, which are developing, I think, are very, very important to watch as well. That's not a plug for me; it's just a fact.
But who would have thought? Who would have thought that more automobiles would be sold over eBay than on all the car lots in America?
Disintermediation is all about replacing people with technology to get a more efficient action. And we see it in the professional services world. We hire more, we buy more computers than we hire people today. Because people know that, and if it's a startup company, we'll give you all the documents. We don't even charge, because we just want to get rid of that whole step so people can start their company and move forward and capitalize. It's a whole different world. You're taking out complete sectors and sections, and to me it's really exciting and dynamic. It's the influence of technology on real estate like never before. Henry, where will you take Guggenheim's capital, and where will you be investing, given your spectrum here of senior debt versus something like a construction loan at a very high risk?
I think we're trying to follow demographic trends. You showed a slide before that showed all the development and sales in New York and London. Those are both recipients of flight capital, particularly London, coming out of the Middle East. The one market you didn't show on the slide where we are also investing is Miami, which is benefiting from the same trend, but from Latin America as opposed perhaps from the Middle East. We think that we try to follow those trends. We hopefully are ahead of those trends from a real estate sense. But those are the markets that we're most focused on. Beverly Hills, obviously, Manhattan, London, and Miami.
It's interesting you mentioned Miami. I mean, I think a lot of what's driving the few places where you do see development is, what I would call de-risked development. So in Miami, you can develop using, pretty sizable deposits for a lot of the cost of the capital, I should say, to build your project. In New York, a lot of the development that's happening on the west side is predicated on having tenants and occupiers before the buildings go up. So it's, where you do see cranes, for now anyway, you see it where there's actual demand supporting it. At least that's what we're seeing from where we sit.
That's correct. In Miami, generally, you're going to collect about 60% of the development cost in deposits before you go vertical.
Yep.
And if that doesn't work, you own a piece of ground, but you're not going to go into the vertical phase.
Interesting.
I think that there's a bigger real estate issue in Miami, and that is all of these zombie neighborhoods. Where you have literally, 1,000 apartments in 4 blocks and nobody is there. I mean, you walk down the street, there's nobody there. except for Christmas or New Year's, and I ask this rhetorically because I don't know what the impact of that is going to be, but I know that there will be an impact because that disparity has all kinds of ramifications about who's going to support the rest of the community if the people living there aren't there.
Yeah, London's got that problem in spades too.
Yes, same thing, except London is a major city.
Yeah.
Miami is not a major city.
Now, now Jonathan grew up there, so.
Huh?
I said I grew up there. Killing me, man.
Well, I mean, we ran a business there. We had to move the business because we couldn't find accountants. I mean, you know, and you know, normally you don't look for accountants, but we
Sam, let me shift this a little bit. Shareholder activism is a pretty trendy topic now. We see Ackman, we see ICOM, we see a lot of folks, and we also hear from you a bit too. You were involved in the Commonwealth REIT battle, and why do you think that trend of activism is emerging now? And can shareholders make a difference and create value, or is this just all just fights for folks to make puts and calls and make a bunch of money on everyone else?
Well, first of all, taking over a REIT is by definition very difficult. Starting with the fact that you can't own more than 10%. In the fewer than 5 and all the other issues.
Right.
In this, I do not believe that the Commonwealth thing is any kind of a harbinger of the future. The Commonwealth thing, in my opinion, comes down to one very simple thing. RMR, which is the external manager, managed that company started it, managed it for a long time. Unfortunately, I think that the external structure disincentivized the manager to focus on profitability as opposed to assets under management. The result was that over the last 10-year period until the activists got involved, Commonwealth Realty, its trading looked like the EKG of a dead person. But that meant that the stock was trading at 50% of NAV. So that created the opportunity for somebody to buy 10% of the company, which they did, do so at probably no more than 60% of NAV, and therefore could put up the money to take on the battle. And that's really what what precipitated and created the situation. I don't know of any other REIT that traded so far off of NAV, creating that kind of a problem. Part of the problem was that the external structure basically meant that none of the normal REIT players participated. So we have 118 million shares in Commonwealth. Not a single share was owned by Cohen & Steers, by Reef, by any of the dedicated real estate funds, which they could afford to do because they made the presumption that the stock would never go up. So as long as the stock was flat, they didn't have to own it. Over the next 3 or 4 months, it's going to be interesting to see because now they're going to have to own it. And at the moment, they own none of it. So it'll be very interesting.
You heard it here, folks. That's an interesting little change in demand. Bill, there's been and this is for my friend Bill McMorrow. The multifamily sector is something which KW has been involved in for a long time, and Kenny Wilson has had tremendous success. Has that market peaked? Is it a class of investment that you are still chasing, or is it something where you're just holding and getting ready to sell, or is this where cap rates show you optimal value?
Well, I think Sam's really maybe better to weigh in on that one, but I think as far as what we're doing, I mean, we're continuing to see opportunities here on the West Coast, in Seattle, primarily. We continue to add to our multifamily business in Dublin. We're the largest apartment owner. It's not a big market, but we're the largest rental owner in Dublin. But we're constantly looking through our asset base to prune things also. So we're selling some things and buying some things, but clearly, really, as Jonathan and Henry said, the rate. When we look at the apartment business, if you look at the 10-year rate over the last 100 years, it's averaged over 6%. And so today, even being able to finance these at 4.5, close to 5%, we think on a long-term basis those are attractive opportunities. We're seeing continued rent growth in the markets that we're in on the West Coast. And so it's a business that we really want to grow, but we all are also pruning assets from time to time.
I don't think, Lou, you can talk about the apartment business without talking about demographics. The demographics in the United States are changing, and the orientation of the population is changing. Not so long ago, the shibboleth was everybody had to own a house. You got out of college, the first time you could buy a condo or something to kind of get into the act and therefore participate going forward. The majority of apartments were built in the suburbs. When we took Equity Residential public in 1993, it was an $800 million company, 100% suburban, low-rise, multifamily. Today, EQR is $34 billion. It's 99% high-rise, CBD, 24/7 cities. That's nothing more than following the demographic trends of the last 20 years. And I think that when you talk about multifamily, I mean, think about it. When I got into
Slide 39, please. Go ahead. I just want to bring that up.
When I got into the multifamily business, highway exposure was an awesomely attractive thing. If the apartment project didn't have expressway exposure, you didn't buy it. Now, if you're next to the expressway, you got a turkey. And I think that there's the best story I can tell you is that in 1965, Motorola went 35 miles northwest of Chicago and built a campus. And all of their new employees were engineers, buying houses in Ticky-Tackyville and driving 5 miles to the campus. In 2006, Motorola rented 200,000 square feet of office space in downtown Chicago while their facility was 40% vacant. Why? Because they couldn't get anybody to go to wherever the hell that was. And they didn't want to find out. And so you have a lot of changes. The deferral of marriage is such a staggering impact on real estate that I just don't think anybody has really focused on how relevant that is. We have 18,000 apartments in New York City that we own. 45% of them are occupied by one person. 45% by one person. Those are staggering statistics, and we're seeing them all over the country, where people are basically making a rental commitment. These Generation O or X or Q or whatever they are, have this big thing they can't spell the word commitment. Well, rental fits that perfectly. I think the future of rental housing is nothing but strong. At the same time, I think the future of the percentage of Americans who own their own house, which historically has bottomed out at 62%, is currently probably 64%, and I think could easily go to 55%. And that's going to have an enormous impact on, quote, the evolution of suburbia, the home builders. I think it's fascinating. We haven't built many houses. We built probably 40% of what we call normal housing in the last 8 years. And the headline says that, new home builders are slowing down because there's no demand. What does that mean? They say there's no demand because of price. That's bullshit. It's not about price. It's about commitment. It's about, now tell me again why
Whoever bet 14 minutes and 51 seconds for the first bullshit, you've won.
I haven't said fuck yet. Come on.
That's 14 minutes and 43 seconds. Thank you, Sam.
I just think the demographic issues I mean, I don't think the multifamily market has ever had a better set of future demographics than it has right now. And I think that it's going to outperform, I think, over almost any measured period of time.
Well, I mean, to your point, Sam, if you look at that chart there, and you see the
Oh, I didn't even see the chart.
74 million, that's the group really that, in part, you're talking about.
You bring that up, please.
Yeah, 18 to 35.
It's that group is not as oriented to make the commitment and to own houses. And so if you're in a market where the demographics are growing like we are here on the West Coast in San Francisco, Los Angeles, and Seattle, without a lot of new construction, that's what's forcing these rental rates.
There was an article on the front page, I think it was the New York Times this week or the Wall Street Journal, that talked about the fact that women could freeze their eggs and then, in effect, follow up their career and then have children later. Think about what that does to the real estate business. Think about what it does to single-family houses. Because the biggest motivator
Think about what it does for the refrigeration industry.
Our children.
But no, but keep going.
Huh?
I just, just keep going. Sorry, it just changes things, everything.
Yeah, and so, but I just think that these are demographic trends that are not minor in nature at all, and very much, very much affect the future of housing in the United States. And I guess what I'm really saying is, I think the future of housing is much more multifamily than it is single-family detached.
Mm-hmm. And urban-oriented.
Very good. Let me turn to a couple of other questions that relate a little bit more to the strategic, your strategies in moving forward. In terms of inbound capital into the United States and external capital moving from the United States to other countries, we're seeing a lot of money, obviously, from China and from countries that don't have a rule of law. When people make money, they come here. Irvine, for example, 80% of the houses that are being purchased in the Great Park neighborhoods, which is the former El Toro military base, 80% are Asian people. 50% of those pay for their homes with cash. There's a lot of money that's coming in, changing neighborhoods, changing lives. Are you, and I'll throw this out to Bill, are you seeing a greater number of folks who are looking to, Bill Kahana, that are looking to invest from foreign countries into domestic stock exchanges or into your product? Do you see, do you follow the number of foreign investors or first-time investors into your product?
You have to understand that of our million investors, about 13% actually hold U.S. passports, and about half of them have used those passports, and half of them have used them to go to Mexico or Canada. So being able to convince that cohort to invest abroad is a challenge. What we did find, though, is that in an effort to create income and chase yield, that we could take a fundamental net lease strategy, transport it, and Bill's seen this in spades, transport it to countries like the UK, Germany, the Nordics, the Benelux countries, follow strong credit, and then spread invest, borrow at slightly greater rates than we can here. But I can buy and have bought a McDonald's credit, for example, in the UK in a secondary market, long duration lease, triple net, at an 8.5% yield, whereas here I can barely touch McDonald's at a 5. So that disconnect, that disruption that's been created first among the Romance countries that has affected all of the EU has created an opportunity, and we'll put about $1 billion of equity to work in the Union over the next 12 months. We are seeing a lot of incoming inquiry looking for dollar-denominated yield against good, strong, hard assets, well managed. It's actually not retail, it's more institutional. And I would reasonably expect that of the $14 billion we expect to raise this year, about $1 billion of that sleeve will be incoming international corporate and sovereign money looking, again, for higher income, dollar-denominated, strong assets?
I think it's less the case that we have new investors as it is the case that the existing investors have significantly increased their allocations to the U.S. So the sovereign funds have been here for a long time. They're just investing a lot more. And the same thing is true of other international investors who had toeholds here in the past. And because of safety and, Russia supposedly has lost $70 billion in the first quarter of flight capital. I wouldn't at all be surprised if a big chunk of it ended up here, or already is here.
I'm going to shift this just a little bit. Can you pull up slide 41, please? Big changes going on in healthcare, gentlemen, throughout the United States. We now have become a green country in terms of with Obamacare and universal healthcare, along with the rest of the world. We can see Brazil and South America, Chile, Argentina, Australia, Europe, Saudi Arabia. You can see where we have universal healthcare, and we're emerging into the green there. What impact is that going to have on real estate and where you're putting your money? Is the socialization of medicine in the United States, which is really what Obamacare becomes, a forced market, is that hurt, hindrance, or just another event that's going to change the flow of capital in a way that we, following how we pursue medical care in the country?
Two quick observations. We have multiple healthcare strategies, and what we've found actually is among our retail cohort, it's the easiest story to tell because our investor base is about 90% 55 years or older, and people have an emotional connection, particularly to their health care. And so they can actually relate, if you will, whether it be to senior housing or skilled nursing, hospital care, and or medical office. So it's a relatively easy investment to make because they see fundamentally 1.5 times a week when they visit the doctor what the demand is for his services, and they understand, I think, intuitively that it's a good opportunity, a good long-lived investment. It's got good demographics behind it as people live longer. And so that story and that emotional connection makes healthcare, from the standpoint of product type, a relatively easy strategy to sell. So our first healthcare REIT at $1.7 billion of equity took us just under 30 months to raise. Our second will take us just under 12 months to raise the same amount of money.
Interesting.
I think one of the problems with your chart is that there's no differential in the color green.
Well,
So
ours is a little darker.
If you want to call Russia having a country with universal health care,
Well, if you get shot, you get sick,
I got a
you get
bridge
shot.
to sell you, okay? I mean that's a joke. At the same time, the disparity between Canada and the United States is very severe. The disparity between Brazil and the U.S. is very different. So I don't know whether this really is something that has much of an impact on decision-making, allocation of capital. I don't think it has any impact whatsoever.
Okay, well, that's good information. But will there be more ambulatory care facilities, looking at hospitals like malls and then having a bunch of smaller ambulatory service type developments throughout, scattered, much the way that an Amazon has to put a big box out somewhere and then fly a drone over. I mean, there's a whole logistical change in healthcare that's happening just like the internet is affecting retail.
And what do you do about all the empty shopping centers in between the malls and the strips?
Healthcare.
Healthcare,
Yeah,
that's
that's
it.
the answer.
That's it.
After churches.
That's right, after churches. Well, in the last 5 minutes, I'm going to just go through and ask each of you gentlemen to give me, for the audience, your one pick on where people should invest, what you think is the strongest thing that you're scene. We've already heard on the Commonwealth REIT. We'll come back to that at some point. But I'm going to start with you, Bill, and we'll just go right down the row here. What's the biggest opportunity out there?
Well, my personal choice is anything Sam's investing in.
Yes, of
But
course.
short of that, our most recent strategy to take advantage of a slowly but deliberately recovering economy is hospitality. So we are looking at select service and limited full service properties that derive most of their bottom line return from the room component, from that component which really generates the lowest effective expense against it. And that, coupled with a strong management company, we think will generate a good solid 7% covered yield with tax deferral and some protection as room rates grow, and that translates into revenue and then dividend growth.
Thank you. Bill?
Yeah, for us, it's multifamily assets in the western United States, and then secondarily, obviously, Ireland and any asset class, really, in the United Kingdom and Ireland.
For me, it's following the urbanization trends. So whether that's street-level retail in major urban centers, whether that's housing of all types in major urban centers, there's sub-communities, sub-markets in the major cities in the U.S. that are being remade in ways that make them really interesting real estate investment opportunities. So to me, that's the place where you get differentiated opportunities.
Well, I have to say this, otherwise I would have to leave the room, but as you walk out going toward Merv Griffin Way, there's 2 high-rise condos, the first high-rise condos ever built in Beverly Hills, so you can sign up with any of my colleagues who are here in the back of the room.
I call that urban, right?
Yeah.
Sam?
I think that in terms of looking forward, I think the single most attractive investment in the world is Mexico. I think that from a thematic point of view, Mexico is in a very unique position. Mexico is probably the single biggest beneficiary in the world of Fukushima, because Fukushima destroyed or impaired the supply chains. And nobody really understands that Japan is a major part of all the Chinese supply chains. So when Fukushima happened, it scared the hell out of all kinds of companies all over the world. The obvious choice was Mexico. And so in central Mexico, as opposed to the maquiladoras along the border, which did assemblage, they are manufacturing airplanes and cars and just growing like crazy. You combine that with the reforms in Pemex. Remember, Pemex represents 40% of the entire revenue source of the government.
Wow.
So if you make even modest improvements in Pemex, the impact on Mexico is going to be staggering. So if you hadn't forced me to pick a thematic approach, that would be my answer.
Okay. I'm going to follow up with a question that I've been waiting to ask for the longest time, because to me, the best place to invest right now is Colorado with the legalization of marijuana.
But you know, you don't have to own anything to buy the stuff. So what the hell do you need real estate for?
To grow it, I guess. I don't know.
No, that you can't do.
Oh, okay. All right.
In other words,
okay.
you know, everything in Colorado is legalized and tracked. So the one thing you won't happen is you won't have every kid growing his own dope on the front lawn.
Okay, well, you just stamped out some hope. Ladies and gentlemen, if you can join me in thanking Sam and Henry, Jonathan, Bill and Bill. We really appreciate it. And we look forward to having you back next year at our real estate panel again. Thanks very much.